Hey, remember June 1st is coming up. We'll have a big price increase on all of the programs on either building your wealth or building your income. A lot of you might not be familiar, but we've got various different amazing programs with all my perspectives on not just investing in real estate or investing in stocks or property management and rental renovations. But we've also got how to make more money as an employee or a business owner, featuring the AI lectures, which are releasing soon. We've also got a program on real estate sales, which is great for all salespeople, lenders, you name it, or making YouTube videos the way I do and learning all of my insights. All of these courses come with lifetime access to the course member live streams, and we keep them updated by continuously adding more content. After we drop these lectures, we're moving into adding new content also to the other courses. So stay tuned for that, and it's always added for free for existing members of those courses. You can also email us for a bundle code at staff@meetkevin.com. Hey, so a lot of people are wondering why the stock market seemed like it retraced into the close. It's kind of like we had this really euphoric, yay, we have a deal, and then we kind of bled out there into the close. What happened? What was the reason for that? Well, there were a few reasons for that, and we're going to break those down. So the first and probably most important is that folks are realizing now that, wait a minute, even though we're really fearful and we're pricing in the recession, specifically because of that inverted yield curve, the economy keeps throwing data at us that suggests maybe we're not here yet, but maybe there are other problems that could keep the Fed hiking for longer. See, we got two sets of data this morning. Number one, we got consumer confidence, and number two is probably even more important. And then we've got some other things coming up this week, which I'll explain. The first is we got consumer confidence, which the expectation was that we were going to get a read of 99 as a consumer confidence read. We ended up beating that by quite a bit. We came in at 102.3. So this is what we got versus what we were expecting. And then in the prior release, we were at 101.3. So you can see we were expecting to go from a prior, we were expecting to actually weaken, but we didn't actually weaken, we actually strengthened. And that led the market to realize, oh, wait a minute, maybe we don't need to price in the recession talk. But then you'd think like, but that's good, right? Yeah, but then it also pushes up the odds that the Fed has to do more, which then reiterates the whole recession narrative that the Fed is over-tightening. See, that's the bizarre thing. In a weird way, it's like, wait a minute, I thought good news is now supposed to be good news again, and this seems like it's good news because it means no recession, right? Yeah, but again, no recession would mean, is the Fed really done with the inflation fight? And that's the second data set that came out that wasn't so good. But before we get to that second data set, let's finish on consumer confidence. So, we were expecting consumer confidence to come in lower. It actually went up. But in addition to that, the prior read was revised. It was revised to be even stronger in the prior month, which now it creates even more confusion because the prior read was actually moved up to 103.7. Now this is confusing because technically that is a little bit of a softening, but everything is still much stronger than everyone expected. And so I think forget about all this noise for a moment right here, because trying to understand, oh, this is higher, this is lower, or whatever, it's just going to make your head spin. Okay? The point here is consumer, which makes up 70% of the economy, stronger. Now you have to think, well, the other part is significantly made up by businesses. Well, what are businesses doing? Well, businesses are spending money like crazy on artificial intelligence now. Even Elon Musk is suggesting, wait a minute, we can't get our hands on enough GPUs. Elon Musk just bought a bunch of space over at Oracle to run AI processing on their servers, and Elon's complaining about not being able to get enough GPUs, which is also leading NVIDIA stock to rise. Now, it's worth noting some people, as just sort of a tangent over here, some people are like, but Kevin, NVIDIA just did a $10 billion shelf offering. Why are they, rug pulling by trying to dump shares on us at these inflated numbers? First of all, that's the point of the stock market, to raise money for your business first. That 10 bill is a lot of extra investment potential that NVIDIA can conduct to make sure they can continue to innovate and provide new products. It's actually the right thing to do. Stock goes up, you dump some of it, especially in euphoric times, so you have more money to keep innovating and keep growing in the first place. It's what the stock market is designed for. Second of all, given NVIDIA's valuation today, that only makes up 1% of the company. And given that the stock rose 2.99% today, basically nobody even noticed that they just raised $10 billion of working capital. And to some extent, that's the beauty of the stock market. So you have to be careful when you hear this kind of nonsense. I hate to say it because I do still like Twitter, but when you hear this kind of nonsense on Twitter, it's like, oh, they're trying to screw us. It's like, no, that's the point of the market, and it's actually a good thing. And nobody really cared. Okay, so here we've got consumers spending more money. We've got businesses now spending likely more money to catch up with this AI craze. And so this is making this whole recession thesis kind of crazy. In other words, maybe the recession's not canceled, but it seems to be continuously getting delayed. The recession was supposed to be Q3, Q4. Honestly, it potentially is getting pushed out to Q1 now. And only I am saying that at this point. I mean, I'm sure there are other people saying it, but I haven't heard anyone else saying it. I keep hearing second half of 2023. But I'm starting to think with the data we're getting, we're probably looking more at like Q1 or not at all. Which is interesting because the more we kick the can down the road, the more time we have for inflation to go away. But then, of course, that's where we got, unfortunately, some not so fantastic news about inflationary numbers. Remember the whole point of seeing inflation come down year over year, and we're expecting inflation to come down at down to 4.1% year over year for headline inflation when inflation comes out in a couple weeks, which is great. But the whole point of seeing this and the core numbers coming down, which core is expecting to come in at like 5.3, still pretty high and sticky. Whole point of seeing this come down is expecting housing prices to come down, specifically rents. CPI doesn't actually show home prices, but it shows rents. But rents can sometimes follow what's going on with housing prices, that is. Now, what's fascinating about this is from May of 2022, you actually saw home prices nationwide drop about 10% to December. Now, they've actually recovered about 7 of those 10 points. So you're actually only down about 3% right now, which is pretty remarkable year over year across the country. Some areas are down more, like Austin or Boise, Idaho, and some areas are actually positive, like parts of Florida, specifically Miami and even potentially Tampa. But the point is, if you're starting to see this recovery in home prices, that could actually lead rents to start slipping up again. Slipping might not be the right word, but the point is, if rents go up again, what do you have? You potentially have pressure on inflation again, because it could mean you actually pressure those core services, including housing. Right now, it's this foregone conclusion that, oh yeah, rents are falling year over year. Rents are going to go down, and that's going to drag inflation down. Well, what if that doesn't happen? And what if rents actually start rising again? Well, now you have an inflationary concern again, which means you do have to go higher for longer at the Fed. And then it brings back the long-term idea of that, okay, well, if the recession comes in Q1, the recession is going to come eventually, then the Fed's going to have over-tightened by Q1, Q2. It'll be the first half of 2024. In the meantime, and in sort of this bizarre, weird way, the stock market had its 2022 decline, and now we're getting this volatile Nike swoosh. So far, it feels a little rocket shippy, so, there's been a little less volatility than we would expect. But it's been doing pretty dang well. A lot of that, of course, driven by the mega caps, because they're investing in AI, and people are excited about that, which is this part. So all of a sudden, this part of the economy is doing great, this part of the economy is doing great, that's basically your entire economy, and housing's starting to recover. It's kind of tough to look at this economy and go, things are that bad. But why then did potentially the stock market slow down towards the end of today? Well, it's because of 3 things. Number 1, we talked about it, the consumer. If the consumer's hot, it means potentially higher rates. Number 2, housing data, which drove up some inflationary fears. For example, we got housing data that just came in, CoreLogic housing data, which suggested on a 20-city basis that we actually got a 0.45% increase versus a 0% month-over-month increase. And then on an FHFA basis, we were expecting a 0.2% increase, and we actually got a 0.6% increase with a higher revision in the prior report. So in other words, hot real estate. So you have the consumer doing well, you have hot real estate, And then we've already talked about, we've got hot businesses. Well, this is the AI part. The consumer part is not actually only driven by debt. It's actually driven by higher incomes and higher savings. The savings rate is actually rising so far in 2023, which is remarkable. It seems like it would all just be driven by debt, but it's not. So all of these are characteristics of, and I know it sounds crazy to say this because you go to the grocery store, it's like, prices are expensive, this doesn't seem right. The freight economy is in a complete toilet in a recession. Commodities aren't doing that well. Yeah, there's some parts that aren't doing well, but all of these, hot consumer, hot real estate, hot business, big business, innovative business, all of these are actually characteristics of I hate to say it, strong economy. So yeah, this strong economy could lead to more rate hikes. But and yes, maybe there are ideas that could suggest we're going to see more stickiness in inflation here. But as long as we keep slowly trending down on inflation, this might be okay. The Fed might look at this and go, hey man, as long as it comes down a little bit and inflation expectations don't unanchor, we're okay with this. We don't want people to lose their jobs. If people don't have to lose their jobs and inflation slowly comes down, we're okay with this. I wholeheartedly expect the Fed to do that through a process known as opportunistic disinflation. So this is a very real potential. In addition to this, it's worth noting we have some catalysts coming up. Friday, you've got jobs data. So now people are talking about jobs data. You've got the mainstream media talking about, oh, but is the debt ceiling actually going to get passed? It's all nonsense. Don't worry about that. And if you want more realistic perspectives on what's going on in this world, make sure you check out the programs, a link down below on Building Your Wealth. Remember, we've got the real estate investing program. This is great for investing. So we've got the investing side. The investing side is real estate, 0 to millionaire real estate investing. Then we've got the stocks and psychology of money group, which is absolutely phenomenal here. We do fundamental analysis together every single day. You can learn the way I do my analysis. And hopefully you enjoy that as well. Then, of course, we've got the do-it-yourself property management and rental renovations group. And then, of course, on the income side, which is different, we have the how to make more money and get stuff done faster course featuring AI. Those AI courses will be dropping soon, but we have a price increase for all of these programs on June 1st, which is coming up soon. So make sure you check out the links down below for this. And if you like my perspectives, you'll get a whole lot more of them. Link down below. Thanks for watching. Bye.